Hello everybody, welcome to another one of my investing videos. My name is Mark, and in this video I am going to talk about how to choose the right option strategy for you as an investor. So let's go ahead and take a look at what I've been doing here. If you've been watching my videos, you know that on September the 10th of this year, about a month and a half ago, I bought one call option on Twitter, and it was a $30 call, and I spent $777.71. And since that day, Twitter had been doing nothing but going down, so I could not have been more wrong than I was when I bought that call. But look what I've been doing. I've been selling weekly calls every single week. Sold a weekly call here, made $50, sold another one here, every week after week, just been selling weekly calls until finally Twitter decided to go back up again. And now I have a brand new option strategy for myself. If you notice, I have one call and I have one put, and the reason that I did that is because Twitter had a good earnings, which is confusing to me because their subscription's gone down. It goes to show that I understand very little about earnings and news and fundamental analysis and what the heck is a stock going to do. Is it going to go up or down? I don't know. But for me, it's all guessing. But options, stock options, give me the advantage of both time and leverage. And those two things alone is enough to make me a profitable investor. And let's go ahead and take a look at how I did on this calendar call. Now, first of all, let me go back to my account here. Okay, notice that this call option contract is up to $9. So I spent $777 for it, and it's up to $9. That's $900. So that alone makes me $130. Now, let's go ahead and look at the transactions. Here, let me go back to September, and we'll start from the beginning. Click the view, and we'll start here. So we have 50, 98, 126, 160, 200, 225, 382, and those are all the green numbers. And then we have 29, I'll round up to 30, 30, 60, 90, 120, 150, 180, 210. Minus 1, 2, 3, 4, 5, 6, 7. So 203. So 382, 384. So let's just say 380. That's what we brought in. And now let's subtract the red number. So remember 380 minus 3, 4, 5, 6, 72. So 78. And then we don't have to count this red number because that's the put option that I bought. So, and we don't have to count this one either because that's the call option. Or no, actually we do have to count that. That's the $30 call. That's the original $30 call that I rolled up. So we do have to count that. So let's start over here. 3, 4, 5, 6, 78 plus 260 would be 238. And so we said 380. So 380 minus 340 would be 40, so $42 realized gain. Now, unrealized gain, if I wanted to, I could have sold to close this call option last Friday, and I could have made another, like the bid 840, the ask 885. I could have made, we'll say 860, 77, so another $90. So I could have made a clear $130, and on a $777, that's about a 20% return. Not quite, maybe 18%, right? 77 would be 10%, so 150, 128, so about maybe 16, 17%, 6 weeks. That's pretty good, right? But if we want to count what I made on my whole account here, 130, so that would be about a 6% return, 5-6% return on my entire account. And that's in 6 weeks. I'm pretty happy making 6% in 6 weeks. That's 1% a week. Means I'll make 52% by the end of the year. And as it stands, I'm beating the S&P. The S&P's in the red, so you got to give me props for that. But notice that now I'm not selling weekly calls anymore. Now I bought a call and I bought a put. Let me go back to my transactions here, show you what I did. So here it is right here. Bought one put, and actually I didn't buy the call. I just kept the call that I already bought. So I'm keeping my $30 call because I'm up, and I bought a put. So now instead of doing a calendar call, I'm doing a strangle. That's what this is called when you buy a call and you buy a put. The idea of a strangle is that because you own both a call and a put, if Twitter goes up or down in a big way, then your loss is limited on one side or the other. For example, this call right here, the most that I can lose is what you see right there, the bid, the ask, 860. I can't lose any more than that. So if Twitter goes bankrupt, I lose $860. But this put option here will be worth about $3,000. I don't expect Twitter to go bankrupt. And likewise, if Twitter goes up to $100 a share, of course I don't expect that to happen, but if it did, it'd be happy days for me, right? Because I would lose what? The bid 720, the ask 835. So let's say I lose 800. This $30 call would be worth $7,000. So I'd be more than happy to lose $800 to make $7,000. That's how strangles work. With the strangle, you're basically betting that Twitter is going to go up or down. You don't know which way, but that's kind of how I feel right now. Twitter had a good earnings, but there's been a lot of volatility in the market in general. And if we go to my trusty trading view here, let me go ahead, type that in, and let's go ahead and put in the SPY, which is the ETF on the S&P 500. Click on the chart here, and this is what you see. Let me get rid of all those scribbles, and let me go to like a 6-month chart. Let me even shrink it down. Let's go to 3 months. Let's shrink it down again. So this is a 1-month chart. So what you see is a ton of volatility. Most of it's been downward pressure, but not all the time. I mean, right here it went down and it went up, right? This little area there. And it looks like it was at about the 288 level, went down as low as 272, and it popped back up to 280 something. And so I don't know what the heck Twitter is going to do, and that's exactly why I bought the strangle. That's why I bought a call and a put. And so now my plan is very simple: to pay off the losing side. And right now the losing side is the put, the money I spent on the put, because I'm up on the call. And so how do I plan to accomplish that goal? Well, it's very simple. If Twitter goes above $35 a share in the next week, I'm giving it a week, then I'm going to sell to close this call option contract, and I'm going to make a pretty penny on that, and that's going to go towards financing the how much did I spend for that put option? I spent $767. So that's my goal, to pay for that put, to pay off that $760. The call I'm up on. I'm up a clear profit. I've made $40 in realized gain of all those weekly calls, and then I'm up another, what did I say, 130 total, something like that. So I'm up on the call. So my goal is to pay for the put. That's the extra money that I spent. And the way I plan to do that, if Twitter goes up, then I'm going to sell that $30 call. And if it goes up to $35, then let's see, how much will my $30 call be worth? Let's go ahead and take a look. Click on Twitter and click on the option chain. Shut this down, and let's go to option Greeks, like that. And now we're going to go to January 17, 2020, and let's look at the delta. Delta is 68, which means that my call option will go up $68 per dollar. So that's another $130. So maybe a little more because it's a little lower. So let's just say 150, makes the math easy. So this put option will be worth almost $1,000, $990 maybe. So I can sell to close this call for $990, and then I can buy a higher call option, a higher strike price call option, and take risk off the table, and all that profit goes towards paying off this put. So if I got $990, that'd be a clear $200 profit, and that will go towards paying off this put. And then I can start selling well, what I would do is I would buy a higher price call. Let's say that I sold my $30 call. Let's go out to 445 days, and maybe I buy a $37 call, which would be worth, if it went up, it'd be probably worth another 130. So I'd spend, I would get rid of my $30 call, which would be worth $990, and then I'd buy this 37 call, which would be worth around $700. And so I'm saving $300 in risk, and then I could start selling weekly calls and maybe sell $40 calls a week out. That's if it goes up. If it goes down, well, then the value of my put option that I bought, and my target price is $31 a share. If Twitter goes below $31 a share in the next week, then I'm going to start selling weekly puts at the $30 level, because my put option will go up in value, and then my call option will become the losing side, and then my goal will be to pay for the call. And so basically it's like yin and yang. My call is my yin, my put is my yang, and if Twitter goes up, then I sell to close this call, buy a higher call, sell weekly calls, and I might even open up a put butterfly. I might even buy another put and just start doing butterflies, and then I could sell higher strike price puts. So there's so many ways that I can pay for this put. I think it's a good strategy, but I think as I close out this video, one takeaway idea that I would like to leave is that you got to change your strategies. You can't just have a favorite strategies. Boy, I really like to sell covered calls. I'm going to sell covered calls. Oh boy, I really like to do credit spreads. You know, you can't do that. You got to look at your stock, and I've chosen Twitter. Twitter is my stock. I've been trading this thing for over a year now, and so I know it pretty darn well. I know the patterns. I know the patterns of the movement, and I know the patterns are very predictable. If we go to a year here, these are all predictable patterns. This pattern right there is predictable. This one right here was predictable. This one is predictable. It has very predictable short-term patterns. Long-term, no clue. I have absolutely no freaking clue what Twitter's going to do in the long run, but I have a very good idea of what it does in the short run, except for right now, because there is so much volatility going on out in the world that with the S&P, the techs have been selling off. So how do I know that Twitter's going to keep going up? It seems to have a mind of its own, but we'll see. But you have to change your option strategies. You can't just stick to one strategy and just go happy days. You really got to study your stock. You got to know what's going on out there, and it's not that hard. I mean, you just pull up an S&P or a Dow Jones, and it's not that hard to figure out, aha, there's a lot of stuff going on, right? So that's really what it takes, and you got to be flexible, and you got to be malleable, and all that good stuff. So that's what I got going on right now. We'll see how I do. So far, I'm doing well. My account's growing slowly but surely, and I would love to double this here in the next year. So far, I'm doing okay, I think. So hope you guys like this video. Hope you get some good ideas and you start investing. Does not take a lot of money to buy and sell calls and puts, so I would get in the game and you know, go to town. So thank you for watching this video. Any questions, leave in the comments, and I will see you in the next video. Cheers.